Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
This is the week of April the 15th of 2019, and I say that because this is the week that the Q1 earnings season kind of ramps up with a lot of earnings beginning to flow in. So what exactly is this first quarter earnings reporting season going to bring us? Well, that's what we're here to find out from our research director, Shiraz Mian. Now, a lot of people out there who watch this kind of stuff have already said that the Q1 earnings season is going to be characterized as dicey, okay? And that's because of the earnings slowdown that we're seeing. You say, though, that the banks, having already reported, many of them, are bringing out some optimism to the Q1 season. Does that mean that you're not looking for a drastic slowdown?
No, I'm still looking for a drastic slowdown. And just to put those numbers in perspective, last year, 2018, the growth for the year as a whole, and each of the four quarters, particularly the first three, was north of 24%.
Okay.
The growth in Q1 is expected to be down negative 3-4% earnings growth, earnings decline actually 3-4%. So what we are seeing in these initial reports from the banks is that the growth is weak. It is a drastic slowdown from what we saw last year, but it is just not as bad. In fact, some are coming out with a lot better numbers than what the market had been pricing in.
So I have to ask you then, is this the beginnings of an earnings recession?
No, I don't think so. And if you get too technical with this, recession being two back-to-back quarters of earnings declines, I do have a chart that I'll share with folks a little later that'll show that current expectations for Q1 as well as for Q2 are for earnings decline. So if you were just going by the definition of a recession, you would say that on this day, if we look ahead to expectations for these two quarters for earnings decline, so today you could say we have an earnings recession, but what actually happens relative to what is expected ahead of the start of the earnings season are two different things. Every reporting cycle results actual growth is 3 to 4 percentage points higher than what is expected before the start of the earnings season. So even though growth is expected to be negative in Q1, I would say when all is said and done, we'll probably be close to the flat line point by the end of this earnings season. Who knows what will happen to expectations for Q2? It's modestly negative now. They could probably go further down, as is typically the case. But I'm not reading too much into these negative numbers. The talk of an earnings recession, it looks good, kind of like a little more sensational in headlines, but substantively it's not a recession.
All right, so many sectors have seen negative revisions since the first of the year. Is the pressure this time around going to be on margins?
Yes, it is on margins. In fact, that's a great point you raise here, Terry. Even in Q1 and also in Q2, when we were just discussing that growth is expected to be negative, both these quarters as well as the rest of the year, revenue growth is positive. In fact, we have 4-5% revenue growth for the year as a whole, and in each of the four quarters, it's the earnings declines, and that's happening because of margins are under pressure.
And what are the contributing factors then to that margin story?
So one major reason why we got the outsized growth in 2018 was the beneficial impact of the tax cuts that really expanded margins. And then on top of that, on top of the tough comparisons to very high margins in 2018, you have some cyclical issues. We are hearing about companies discussing higher expenses in terms of logistics, transportation, the trade issue globally between the U.S. and China, between the U.S. and Europe. That's forcing companies to rethink their supply chains, which again adds to expenses. Payroll expenses are going up. Other input costs, because again of tariffs on steel, aluminum, and other input. So tough comparisons, number one. And then on top of that, you have these cyclical issues that are raising some of these line items for these companies, and that's having a bottom line impact.
All right, let's take a closer look here. The bank earnings were among the first out. Some reported before today, others still reporting today, and other financials will be reporting through the week as well. So to clarify, they bring a mostly, right now, positive tone to that sector?
I would say so, yeah. I have a chart that I want to share with people here. And as of today, we have finance sector results, as I have in that little text at the top of that chart. 25% of the market cap of the sector in the S&P 500 have reported results already. So JP Morgan, Wells Fargo, Goldman, Citigroup. And as you could see in that visual, on the left-hand side, we have the growth comparison for these companies, and on the right-hand side is the proportion of these companies beating estimates. Okay. So as we mentioned earlier, growth is challenged, and we see that in this visual as well. But the right-hand side, you could see that 88.9% are beating EPS estimates, 66.7% of these finance companies, these banks, are beating revenue estimates. This is a higher proportion of these companies than we have seen in the recent past, and that's what I was referring to earlier, that it's adding to optimism for the sector as well as for the broader index as well.
Since we're still relatively early here in the reporting season, what other scorecard stats do you have in so far?
Fair point. This is very early. 33 index members have reported results already. For these 33, earnings are down 3.5%. Revenues are up 2.8%. Remember, we were discussing the margin issue earlier. 81.8% are beating EPS estimates, and 57.6% are beating revenue estimates. The visual that I have here is comparing the EPS beats and the revenue beats for Q1 relative to what we have seen in the past. We are not seeing as clear a trend here as we saw with the banks, but it's nevertheless not unusually weak. But as you rightly point out at the top, it's early. It's early to look for clear trends. That said, growth is challenged. The best we could expect for Q1 is, as we mentioned earlier, to be flat, 0% growth. And it's hard to get excited about 0% growth.
All right, so to be clear, 0% growth, that's your Q1 growth forecast at this point, right?
That's correct.
Against the backdrop of guidance, and the last I saw, the ratio of companies putting out negative guidance to those with positive is the highest since the first quarter of 2016.
That's correct. So I have a chart here. The 0% is I'm sticking my neck out and looking ahead 6 to 7 weeks as to what will happen to the Q1 growth after we close the books on the Q1 earnings season. We have just started the books, so we are nowhere near close to closing the books on it. The highlighted portion in this chart is spotlighting Q1. Okay. And I wanted to show this chart because it gives you a good sense of where growth has come from. Okay. And you could see that in the preceding 4 quarters, which shows the entire 2018, growth is north of 20%, 24, 25% actually. And in the same chart, you could see that it's modestly in the negative in Q1 as well. I think when all is said and done, this 3.8% decline will either become 0% or just be a shade in negative. That's my my expectation for Q1, which will be a lot better than what we have currently.
All right. So, with regard to earnings and the stock market, even with this earnings decline that we've been talking about, are earnings still going to be a key factor in any positive stock market movement that we see from this point?
That's the great question, Terry. My sense is that the market has already discounted the drastic deceleration, as you put it earlier, in 2019, and the market is crediting the tough comparisons because of the tax cut legislation, and then some of these margin pressures that we discussed as well. The key question in the eyes of market participants is what happens to expectations for the second half,
right,
and particularly for 2020. As we can see in the last chart I showed, the first half is negative, but there is growth in the second half. What we don't show in that chart, but I could share here, that growth in 2020 is expected to be 9.5%, 10%.
It's interesting.
And it is this evolving expectation for earnings that I believe is underpinning what the market has been doing lately. If those expectations come down, if estimates for the second half, and even more importantly for 2020 start coming down, then I believe the gains we have had in the market would be in trouble.
Well, here's hoping they don't come down.
That's correct.
At least with any positive momentum that we pick up in the second half. Hopefully
Absolutely.
That's sustained into the new year. We'll check in with you again sometime in the future. In the meantime, don't forget to keep up with Shiraz's earnings trends comments in his written version of his earnings outlook on Thursdays on Zacks.com, and Mondays earnings previews, where he kind of outlines what to expect with earnings reports for any given week during the earnings reporting season. With Shiraz, I'm Terry Ruffalo.